All right. Good morning, everybody. Happy Monday, all you magnificent melon heads. It's September 11th, 2023. Top story this morning is the U.S. dollar, or should I say the Asian central banks are taking cheap shots at the U.S. dollar this morning. I don't know if they're cheap shots, but they're defending their currency. The dollar has been on a tear this year, especially for the last couple of weeks, 8 consecutive weeks higher in the U.S. dollar. And then this morning, we've got central banks in both China and Japan are playing defense a little bit, or I should say they're counterpunching against the U.S. dollar. First, we had the PBOC, that's the People's Bank of China, that's the Chinese Fed. They came out and they were warning foreign exchange speculators, do not destabilize the yuan. Well, China doesn't really make suggestions. When the Chinese government politely suggests that you not, say, sell yuan to buy dollars, you better listen. That means if you keep selling yuan to buy dollars, you're going to disappear in the middle of the night. So that sent the Chinese currency a little bit higher against the dollar, putting a little bit of downward pressure on the dollar this morning. But we also had Kazuo Ueda over at the Bank of Japan. Again, that's the Japanese central bank. And he gave an interview last night where he mentioned that he thinks possibly as soon as the beginning of next year, Japan may be able or may be ready to end their policy of negative interest rates on some of their shorter term interest rates. Well, the yen is a big player in the DXY math, or the US dollar index. So that sent the yen stronger against the dollar. So those two actions by the two central banks in Asia, and keep in mind, these are the second and third largest economies in the world. So on the same day when they both decide they're going to counterpunch against the dollar, go figure, the dollar is lower this morning. And with the weaker Dixie this morning, that also is putting upward pressure on stocks. It's putting upward pressure on commodities. And that is the biggest story going on this morning. Also, we've got some worrying news about the U.S. consumer. There was a survey at Bloomberg that says a lot of people are starting to expect the consumer to weaken as soon as the end of this year, certainly by the beginning of next year. Keep in mind, guys, we are just a few weeks away from student loan payments resuming for 1 in 10 Americans who have something like $400 a month in student loan payments coming back. Americans who are already up to their eyeballs in credit card debt, Americans who are already struggling to meet the rising cost of inflation and the increase in the cost of living, and their wages have not kept up with the increase in that cost of living, and now student loan payments are coming back. Well, we're a consumer-driven economy, so if Americans slow down their consumption, the economy is going to slip into recession, which we would already be in a steep recession now were it not for this massive increase in government spending brought on by things like the CHIPS Act and the Inflation Reduction Act and government budgets, or should I say lack thereof, because, well, just help yourself to another trillion on the way out the door. And with that, let's shrink my big melon of a head. While we're shrinking the melon of a head, won't you please inflate that like button, folks? It really does help me out with the YouTube algorithm. And if you're new to the channel, won't you stay a while? Hit that subscribe button. We do this every morning, and I would just love to see you guys here tomorrow. The fear-greed index is still at neutral, just barely into greed territory at 51. We've got the S&P this morning is set to open 27 points higher, or 0.61%. Again, I think that is not really driven by any optimism about any companies. More so that weaker dollar this morning is sending stock values a little bit higher. We have got the Dow is set to open 107 points higher. That's about 1/3 of 1%, and gapping up at the moment. We got some green candles happening right now, and the NASDAQ leading the way higher. The tech-heavy NASDAQ index is set to open 140 points higher right now, almost a full percent, 0.9% higher pre-market for the NASDAQ. Looking over at the commodities, they too are liking this weaker dollar today. We have got gold, December gold futures trading at 1951.55. That's up just under $9, or about 0.5% this morning. December silver futures trading at 23.41. That's up 24 cents, or 1%. We got platinum and palladium are both about 1% higher. We got $904 for October platinum futures. Palladium December futures at 12.12. Crude oil being the one exception here. We got a little bit of red on West Texas Intermediate. October futures trading at 87.25. That's down about 1/4 this morning. Looking over at the yield curve, we've got bonds are largely higher this morning. I should say interest rates or yields are largely higher this morning, which means bond prices are down a little bit The 30-year U.S. Treasury is yielding 4.37%. That is higher by about 3.5 basis points. The 10-year Treasury is just under 4.29%. That's up 3 basis points this morning. 2-year yielding 4.995, up 1 point, just below that 5% mark. And the 1 month still at 5.39%. And this is the one that I think is causing all the hoopla this morning. We've got the DXY, or the U.S. dollar index, is down by 41 basis points at 104.68 this morning. Again, the dollar has just been on an absolute tear these last couple of weeks, rising very fast. It was only a matter of time before we started to see some kind of a defensive move from foreign central banks. I don't think this is the last one we're going to see, especially not from Japan. I think the dollar will weaken a little bit on the heels of this news before resuming its move higher, and then we'll probably get more counter moves from the Asian central banks in the future. Here is the story at hand, though. The U.S. dollar starts the week under pressure as China and Japan defenses bite. The yuan surges as the PBOC pushes back against FX speculators, and the yen jumps as traders mull hawkish comments from the BOJ's Ueda. Remember, Ueda Kazuo, or Kazuo Ueda in Asian cultures, the family name usually comes first. He is the new head of the Bank of Japan, and he was largely expected to start tightening pretty much on day one when he took over at the BOJ. He took over at the end of March, and he surprised a lot of people because he wasn't quite as aggressive early on as people thought he was going to be. And so the yen has weakened substantially over the last few months, as Ueda has actually ended up being more of a dove than people thought. He still moved in a hawkish direction, but not nearly as aggressively as most people thought. So yesterday or last night while we were all sleeping, he got a little bit more aggressive, and so the yen is strengthening. The dollar's record hot streak came under threat Monday as Asia's biggest central banks took aim in different ways at the recent rally in the greenback. The People's Bank of China gave a strong warning to speculators to steer clear of destabilizing the yuan, while the head of the Bank of Japan took a more subtle approach and hinting at the possibility of an eventual policy shift in an interview which sent the yen soaring. The Bloomberg Dollar Spot Index fell as much as 0.6%, the most since August. And I just want to show you guys a couple of things. This is the Japanese 10-year government bond, or the 10-year JGB. And you can see, humming along here, bouncing around between 0.6 and 0.65. Then last night, Ueda gives this interview. He mentions that they may back off from negative interest rates. And then all of a sudden, wham, up we go on the 10-year JGB. It popped from about 0.64 to as high as 0.695. So about a 5 basis point move. Now, keep in mind, guys, that the Bank of Japan is artificially suppressing the yields on these bonds. So this is the Bank of Japan, number one, jawboning, coming in and saying, hey, we're going to start to be a little bit more hawkish. But they're also allowing this yield to rise. When you see this move up of 5 basis points, what would have happened a few days ago is the Japanese central bank would have come in and started buying those bonds, raising their prices and pushing those yields back down. So they're allowing it to rise here. This is another 5 basis point increment up. The Japanese have been saying they're about to back off of their yield curve control. They're going to let rates start to rise. Right now, they're basically saying we're going to let the 10-year float anywhere from 0 to 1%. Ever since they said that, we've been rising in these little 5 basis point increments every couple of weeks. There was another one last night. And you can also see it in this chart. This is the U.S. dollar in Japanese yen, or the number of yen it takes to make $1. This is only going back to about midnight last night. It's currently at about 146.5 yen to the dollar. Now you can see here, we were humming along. Here is Ueda's interview, and wham, right down it goes. That is the yen strengthening, the dollar weakening against the yen, and then it's bounced around a little bit ever since then, settling at a lower place, currently at about 146.54. Also going on this morning, I found this one pretty interesting in Bloomberg. The mighty American consumer is about to hit a wall, investors say. A key engine of U.S. growth is poised to sputter in early 2024. That's according to a survey of respondents. After staving off recession for longer than many thought possible, including myself, the U.S. consumer is finally about to crack, according to Bloomberg's latest Market Live Pulse survey. More than half of 526 respondents said that personal consumption, the most important driver of economic growth, especially here in the U.S., will shrink in early 2024, which would be the first quarterly decline since the onset of the pandemic. Another 21% said that the reversal will happen even sooner in the last quarter of this year as high borrowing costs eat into household budgets while COVID-era savings run down. And this bar chart here is showing the American consumer is approaching a tipping point when they are being asked when U.S. consumption will turn negative on a quarterly basis. All right, so when will we be spending less on consumption versus the prior quarter? We have got 21% of respondents here in black saying, hey, as soon as this current quarter right now, we're at the end of the third quarter right now. We've got October, November, December would be the fourth quarter. So they're saying as early as next month that could start. And I think I would probably find myself in this camp here on this black bar because of the return of student loan debt. I think that's going to be a bigger impact than people realize. People are already stretched to the breaking point. Another $400 a month. That's got to come from somewhere. That's going to come out of consumption. But look at this. 56% of people here in pink are saying in the first quarter of 2024 or early 2024, which I interpret as the first quarter, 56% of people saying consumption will slow by then. So combined, we've got 77% of respondents are saying that consumption is about to slow. We are a consumer-driven economy, so that means recession is coming. So much for that soft landing. But we've still got about 23% of people here in yellow are in that soft landing camp saying that consumption will remain positive for the foreseeable future. I cannot imagine what's making people say that. They're drinking too much of the Yellen strong and resistant Kool-Aid, I guess. Looking over here, I just want to give you a couple of data points that are, in my opinion, support this survey results that says, hey, consumption is about to slow. First off is this one. Consumer loans and credit cards, all revolving plans for commercial banks. This is America's credit card bill. I've shown this chart a few times. You can see here we had about $858 billion of credit card debt when the pandemic hit. And then we all got locked inside. Nobody could go out and spend money. Everybody got stimmies. And so Americans paid down their credit card debt. That is right up until about the middle of 2021 when we got a little taste of freedom, goody, and everybody went out and started spending. And look at how America's credit card bill started rising, and it just has not slowed. It's still rising past $1 trillion, currently sitting at $1.012 trillion in credit card debt. And guys, I would add, as this debt is rising, the interest rate on that debt is exploding higher with the Fed's rate hikes. So this is Americans putting the cost of inflation on the credit card. Well, sooner or later, those credit cards are going to dry up because banks have started to restrict lending. Banks are playing defense, especially after the bank failures in March. So sooner or later, these credit cards are going to be taken away from people. And when that happens, there's nothing left to do. They won't be able to spend anymore. Now, I'm also keeping an eye on delinquency rates for credit cards. Now, this is the delinquency rate for credit card loans for all commercial banks. This chart is not very alarming. All right, here we are right now. We're only at 2.77% delinquency rate for credit cards. That's as of the most recent data at the end of August. All right, so we're higher than we were pre-pandemic, but only a little bit. We were 2.66% at the beginning of 2020. Right now, we're at 2.77%. And you'll notice we're nowhere near the highs that we saw during the GFC when we peaked at 6.77%. So delinquencies on credit cards are not all that bad, at least not for all banks. But it's interesting when you look at the delinquency rate for credit cards issued by small banks, we get a different picture. Check this chart out. Same time period. This is the delinquency rate for credit cards, but this is for banks that are not among the 100 largest. So this is credit card loans taken from small banks. And now the delinquency rate here is telling a totally different picture. We're currently at 7.51%. That is an all-time high for this chart. Now, this one only goes back to the 90s, but it has never been this high. 7.51% delinquency for credit cards issued by small banks. At the peak before the pandemic, we were only at 7.17%. And even during the GFC, that only peaked out at 5.61%. During the dot-com bubble, about 6.5%. So credit card delinquencies for small banks is currently at an all-time high. Now, that's important, guys, because small banks are already in trouble. Small banks are already struggling with losses from U.S. Treasuries, unrealized losses. As interest rates rise, bond prices go down, so small banks have been hurt by that. We've also got small banks are more exposed to commercial real estate than their larger cousins, so the small banks are being hit by commercial real estate delinquencies that are on the rise. And now we've got this alarmingly high delinquency rate in credit cards for small banks at 7.5%. So small banks are in trouble here, guys. That is the takeaway from this. And small banks cannot as easily access capital as the big banks. It's not as easy for them to get through the hard times. So I think we are looking at more consolidation in the banking sector. It is coming, guys. There are more bank failures coming, especially among the smaller ones and the regional ones. Keep an eye on that. Those rising credit card delinquencies. And keep in mind, guys, this is at an all-time high, and the student loan payments still have not started for most people. So that's not going to help things, that's for sure. It's almost certainly going to make things worse. And last but not least, I got to talk about this one. Jelly giant J.M. Smucker agrees to buy Twinkie Maker Hostess brands for $5.6 billion. Guys, I'm not really terribly worried about this story. I just really, really wanted to say that's a big Twinkie. I love that line. I love that movie. So Twinkie Maker getting bought for $5.6 billion. All right, guys, that's all I got for you today. I want to say don't forget to get your tickets to the Silver Symposium. There is a link in the description down below. Caesars Palace in beautiful Las Vegas. We're just 2 weeks out from the Silver Symposium. I can't wait to meet you guys in Vegas. I also, wait. Oh, kill the music. I didn't get you guys in the Super Chats. Oh, man, I am remiss this morning. Charles Coughlin, almost missed you there. The Princess Di Beanie Baby still sells for thousands of dollars. Of course it does. Of course it does. And that's why I'm hanging on to my Aragorn Burger King glass, honk, honk. Collectibles. Guys, when money gets tight and when there's a credit crisis going on and everybody is looking to sell everything, collectibles is the last thing in the world you want to have your money invested in. Let me just put it that way. All right. If you're a hobbyist and you like to collect something, enjoy life, right? That's your entertainment money. All right. But collectibles as an investment, that is an asset class that does not hold its value over time. Even if your Princess Di Beanie Baby went from $2 to $10,000, eventually it's going back to $2. So collectibles, not really the best investment. That's why, like when it comes to the shiny, I don't like to get into the numismatics or the collector's coins. I just like basic weight. I like my generic bars and my generic rounds. But thank you very much, Charles Coughlin. I appreciate the super chat and the support of the channel. And thank you, Dan Hedin, for your super chat, sir. I appreciate that very much. He says, but I just got a tweet from Joe telling me we have the best economy in the world right now. Come on, man. It's strong as hell. Best turd is still a turd. What does it say? The cleanest dirty shirt? Is that how they call it? Look, when it comes to the U.S., when things get bad, the U.S. is probably, believe it or not, going to be in better shape than most global economies because we do still have the world reserve currency. That is an exorbitant privilege. Unfortunately, it's a privilege we're going to abuse. So we'll probably be able to watch them try anyway. They'll start printing money and start handing out stimmies when things get bad again. That's going to make the inflation problem worse. It's going to make the inflation problem much worse for other countries. But at the end of the day, the U.S. has resources. We have a big country with a big population. We have a strong military. We have food secure. We are relatively energy secure. So the U.S. economy is in better shape than most. But again, as you so eloquently put, Dan, best turd is still a turd. So thank you guys for the super chats and the support of the channel. And I just want to say thank you so much to my Patreon supporters for everything you guys do for the channel. I really appreciate you guys supporting my work. There is a link down in the description below, should you feel so inclined. Don't forget to get those Silver Symposium tickets. There's an affiliate link down below. That'll get you 10% off your tickets. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.